Right now, Opendoor Technologies, ticker OPEN, is trading at $8.105, up about 1.69% on the day. But that intraday number, that $8.10 price, is one of the most deceptive figures on the entire market. Most people looking at this see a beaten-down housing stock, a casualty of the Federal Reserve's rate hikes, that's finally getting some relief. They see a stock that's up an astronomical 1,300% from its 52-week low of nearly 50 cents, and they assume the recovery is in full swing. They believe the expectation is that the iBuying model, which was left for dead, has suddenly been fixed. But that is not what is happening here. The reality is that this price has almost nothing to do with Opendoor's fundamentals, their home flipping profits, or even the housing market itself. The reality is that this stock has become one of the most explosive and dangerous battlegrounds between retail traders and institutional short sellers in 2025. As of the last official report, Opendoor's short interest stands at a staggering 27.4% of the entire float. That means for every 10 shares available to trade, nearly 3 are held by investors betting it will crash. This is the story the intraday chart doesn't tell you. The common belief is that Opendoor's fate is tied to mortgage rates. When the 30-year fixed rate hit 7%, the stock was worthless. If the Fed pivots and rates fall, the stock will rocket. This is a simple, clean narrative, and it's what most of the financial media discusses. But it's wrong. The reality is that Opendoor has been co-opted into the new meme stock basket, right alongside names like GameStop and AMC. Its daily movement is no longer driven by housing data. It's driven by options volume, retail sentiment on X and Reddit, and the immense pressure building on that 27% short position. The stock's volatility is extreme, a clear sign that fundamental analysis has left the building and a purely technical, flow-driven war has begun. The expectation is an investment in real estate. The reality is a bet on a short squeeze. Let's look at the trading action. The volume on this stock is almost unbelievable. On many recent days, the average daily volume has exceeded 150 million and has sometimes neared 300 or 400 million shares. When you have that much activity, the days to cover for short sellers, the time it would take them to buy back all their borrowed shares, collapses. Recent data from FinViz puts that number at just 0.47. That means if a squeeze did ignite, the shorts have less than half a trading day to cover their positions before they are completely run over. This is the definition of a tinderbox. The low days to cover means any piece of good news, or even just coordinated retail buying, can lead to a violent, parabolic price spike as short sellers are forced to buy back shares at any price. This is what we've seen in the stock's run-up from under $1 to over $10. It's not a reflection of Opendoor suddenly selling thousands more homes. It's a structural market dynamic at play. This brings us to the core of the fight, the short thesis versus the squeeze. The bears, the ones shorting 27% of the float, have a very simple and, frankly, very strong argument. Opendoor's business model is iBuying. They buy homes directly from sellers, perform light maintenance, and try to resell them for a small profit. This model is incredibly capital-intensive and exquisitely sensitive to interest rates. When interest rates rise, two things happen. The cost for Opendoor to hold these homes on its balance sheet explodes, and the pool of potential buyers for those homes evaporates as mortgages become unaffordable. The shorts are betting that the company is a walking balance sheet disaster. They see the upcoming earnings report on November 6th as a day of reckoning. Management has already guided for a weak third quarter, with revenue projected to fall around 36% year-over-year. The bears believe the company is bleeding cash and that this retail-fueled rally is a temporary gift, giving them a perfect $8, $9, or $10 entry point to short the stock back to its fundamental value, which many analysts peg at closer to $1.30 to $2. But then there's the other side. This is where you as an investor need to be aware. The short interest data itself is the catalyst. Retail investors and certain hedge funds see that 27.4% figure as blood in the water. They're not buying the company's future earnings, they're buying the squeeze. They're looking at the massive institutional short position and betting they can force a GME-style event. And what's fascinating here is the split in smart money. Recent 13F filings, which show what institutions own, paint a picture of a civil war. On one hand, you have massive traditional funds like Vanguard and BlackRock, who drastically reduced their positions. They see the fundamental risk and want no part of it. But on the other hand, you have filings showing that Jane Street Group, a massive quant trading firm, took a new 5.9% passive stake. And reports have noted that Renaissance Technologies, arguably the most successful quant fund in history, has also been accumulating shares. These firms aren't buying Opendoor because they love flipping houses in Phoenix. They're playing a different game, a game of volatility, options, and market structure. When you see quants like Jane Street and Rentec on one side and traditional funds like Vanguard on the other, you know you're in the middle of a major dislocation. So, what does Opendoor actually do when you strip away the meme narrative? The company was supposed to be a tech-first real estate broker. Its algorithm would price houses accurately, allowing it to make razor-thin margins at massive scale. It was a beautiful idea in a zero-interest rate world. But when the market turned in 2022 and 2023, that algorithm was humiliated. The company was caught holding thousands of homes it had overpaid for, leading to billions in write-downs. The stock collapsed. Now management is desperately trying to pivot. They're pushing a new capital-light strategy, becoming more of an agent-friendly platform. They're trying to build a marketplace, partnering with real estate agents and offering services like Cash Plus to generate commissions without taking on the balance sheet risk of owning the inventory. This is the long-term bull case, that Opendoor survives this nuclear winter for housing and emerges as a leaner, smarter real estate platform. The problem is whether it has enough cash to survive the transition, especially when its core iBuying business is still struggling so profoundly. This is why the upcoming earnings call on November 6th is so critical. It's not just about the Q3 numbers, which everyone expects to be ugly. It's about cash burn and the strategic pivot. How much cash did they burn through? And how much revenue, if any, is this new capital-light model generating? If they show progress on the new strategy, the bulls will have a kernel of a fundamental story to add to their squeeze narrative. If the cash burn is worse than feared, the shorts will feel vindicated and may even double down, pressing their bets. What's your take on this institutional divide? Do you think Jane Street and Rentec are right to play the squeeze, or is Vanguard right to run for the hills? Comment below which side of that smart money trade you're on. For anyone trading this, you have to understand the short seller mechanics. A 27.4% short interest is exceptionally high. You can track this data on platforms like Fintel or Ortex. But the number to watch isn't just the percentage, it's the cost to borrow. The borrow fee rate is the interest rate short sellers must pay to borrow the shares. While I don't have the live rate in front of me, if that rate starts to spike, it means the supply of lendable shares is drying up. A high borrow rate can, by itself, force shorts to cover because their position becomes too expensive to maintain. This is an actionable signal. Watch the borrow rate. Also, watch the options chain. The massive call option volume is what often ignites these squeezes, as market makers who sell the calls are forced to buy the underlying shares to hedge their position, creating a feedback loop. This isn't investing. This is advanced market structure warfare. Don't chase a squeeze you don't understand. The risk here is monumental. The same forces that can send this to $15 can send it back to $2 overnight. Looking forward, the expectation is a binary outcome. The bulls expect a squeeze followed by a long-term recovery as the housing market normalizes and the new business model works. The bears expect a collapse as the company's cash burn and weak guidance finally break the retail-fueled fever. The reality is that both can be right. The stock could absolutely squeeze to new highs, letting the short-term traders and quants cash out, only to then collapse back to its fundamental value months later, wiping out those who held on. So here is the real picture of Opendoor Technologies. It is not a housing stock. It is a battlefield. The company itself is in a race for survival, trying to pivot its entire business model before it runs out of cash in one of the worst housing markets in modern history. But the fate of its stock price for now is completely detached from that race. The stock is a pawn in a much larger game, driven by a 27% short interest, massive institutional bets on both sides, and a highly coordinated retail army. The expectation is that you are buying a piece of the American housing market. The reality is that you are stepping into a war zone, and the price on your screen is just the latest skirmish line.